crypto markets plunge below supports on thin 4th of July liquidity. Over $1 billion of exposure is liquidated across Bitcoin and Ethereum, but dip buyers are seen as Bitcoin ETF inflows pick up. Short-dated volatility and put skew spikes massively as a technical bull trend comes into question. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran from Options Insight. I've got my man Dave from FRNT here. And today's special guests are co-founders of Immersive Finance, William McGhee and Katia Babbar. Welcome.
Thank you. Thanks for inviting us.
Thank you for the invitation.
No, it's great to have you here. Remember, like and subscribe to this podcast so we can get more guests like this on and you can learn about what's going on and what businesses people are building within crypto markets. So guys, why don't you tell us a little bit about your backgrounds?
For sure. Shall I start?
Sure.
So I have been a quant in the industry for FX options for 20 years. And in my last 5 years, I also built an algo trading business in FX market making. And about 3 years ago, I was attracted to crypto because I saw there was something there. And at that point, I guess not many institutional players were yet entering the space. And I was exposed to what was happening both on the options side, because I was an advisor to a crypto options exchange, but also I saw the emergence of the decentralized finance business in the summer of 2021 it was. That's what sort of brought us together. And from my side, I could see that the market would grow. There would be more institutional players coming on board. And given our backgrounds and my background in FX options, I felt, well, the options business in particular would, pick up and become as large as it can be.
Yeah, I mean, it's huge in TradFi, right? I mean, options are just running things in TradFi. It's crazy the volumes that are going on in singles. If crypto ever does that, if crypto options ever overtake like that, it'll be amazing, right? So
it's fun as well. Like someone with an FX background as well. I think we've mentioned this before. Like former colleagues of mine who's still in that space. I'm like, and we'll have the arguments or the questions around like, what is Bitcoin? And I'm like, well, if we can accept that it's now an established asset class and this thing's like a 70 volt asset class, why would you not want to be involved in it?
No, I'd rather trade 5 volt euro dollar thing. Yeah. So William, what about you? Do you want to give us a bit about your background?
So in terms of my background, started in traditional finance 30 years ago. Just had my 30-year anniversary of traditional finance.
Congrats.
Yeah, I should be retired by now. And really did everything. Initially started my career as a quant on the FX option side, did some exotics trading, built correlation products businesses, was global head of quants for a UK investment bank, set up a machine learning AI team. Then I moved to the hedge fund side and spent a few years on the hedge fund side. Left traditional finance, I guess, about 3 years ago. A friend of mine had again moved into crypto and he sucked me into the crypto rabbit hole. So he had been focusing on crypto options. He was involved in a crypto options exchange, and he pointed me at AMMs, Uniswap AMMs, started trading them myself. And an AMM is essentially a short gamma, long theta position, so very similar to options. Looked to try and hedge some of my exposure, found Deribit, which was the biggest exchange in the market. And then, was trading an AMM on one side, hedging it with options on the other side. But then you immediately run into the problem, there's no real systems out there in order for you to see your portfolio, your risk of the type that you would find on a trading desk at a big investment bank, which we had essentially built throughout our careers. So then really just started building that for myself. And Katia says, well, if you have to build it for yourself, there's probably a lot of people who come from TradFi, and there is a lot of options traders come from TradFi, come over to crypto and they will have the same problems as you have. So why don't we just turn that into a business?
Interesting.
So that's how we sort of like got into Immersive Finance.
Nice. So you're solving the problem us traders have to basically have the analytics that we need to be able to trade this stuff properly.
Yeah. So Zena, if you come to crypto as a TradFi options trader, our type of platform will be very familiar to you if you're on an options desk at a big investment bank.
Right.
So it combines portfolio risk management, P&L, we have a big data suite, and then we combine those together to build a backtesting framework as well. So a lot of our customers are either options trading desks, but we have the likes of, say, systematic hedge funds as well. And they have a view on strategies that they want to run. And we give them a platform that allows them to test out the strategy, see how it performs, and then translate that onto trading it onto the exchange.
And Katia, what is it that sort of differentiates Immersive from some of the other analytics providers out there? Because there's a few of them that have popped up, obviously, over the same sort of period of time. How would you differentiate yourselves?
I'd say the depth of the product suite that we offer, and to William's point, is just not an analytics platform. It is not just a data platform. It's all of it integrated together, and the ability to run that at speed. So the point is that it's quite institutional grade. So it is geared towards large portfolios. It is geared towards sort of being able to run risk very fast, because this is how we specialize. And so the risk reports and the level of risk reports that you can run are very big. And with that, you can identify both opportunities within your portfolio, but also the hidden risks, because with options, it's a non-linear book. So the importance of what we do comes at that point.
Okay, so it's the risk management element that really, it's not just analytics, but you can plug your positions into it and you can do all sorts of scenario analysis, like changing different factors.
That's right.
At the same time.
Yeah, and I'd say it's a little bit we do have a front end, we have API connectivity, but it's the reliability that we have around the grid as well, the sort of cloud. So you could actually send your request and it comes back super fast. And I think that's what traders love, is to have that knowledge at their hands.
Yeah, for sure. No, it sounds like you're positioned great for a growing market where more and more traders are going to put more and more capital into this space, I guess, right?
I guess what we didn't speak as well is that this is somehow the layered one, the sort of, if I can sort of use that, is the layer one of what we're going to build, because where we really believe that there's going to be even further growth is on the structured product side. And to provide the models and the infrastructure to run risk on the, exotics or barrier, which allow trading houses and sort of wealth managers to offer capital protected type of products, to sort of, allow retailers to come in, retail users to come in, have exposure to the asset class, but have capital protection at the same time. That would be the dream. Yeah. So retail users do not get burned, and you sort of have more and more adoption of the asset class itself. But to build that, it's quite a lot. But this is what we have done throughout our careers. So we have the expertise in-house in order to sort of really help in the background all market makers, trading houses who are interested in offering that.
I think it's quite interesting as well, because you guys have been quite, a fundamental part of what was built in TradFi, and like with FX options and all that stuff. And now, like, it always just feels like a natural progression, evolution to bring that to crypto. And it was part of what got me into sort of crypto and wanting to transition my career into this space, was to kind of recreate and build what we built in TradFi, like, into this space. And so I think you guys are definitely the guys to be doing that in
it's like importing the intelligence over, right?
Yeah. And I always say, like and even like from like the macro side and like my sort of view on Bitcoin and crypto broadly, we kind of, the evolution of finance that went on for decades, we're replicating that almost perfectly, but just in a much quicker time frame.
On fast forward, and
it's which is why it's such a massive opportunity. I think
that's partly helped by the fact that TradFi has just been on a systemic decline as well, right? Yeah. The amount of money bankers can get paid and all the regulations that came in and stuff like that, it's just secular decline, whereas this is in a secular growth trend.
Yeah.
Right. So where do you want to be? Right.
Yeah.
It feels a lot better to be riding a growth trend than the opposite.
Yeah. Although you say that, the last week it didn't feel that good.
No, it didn't. And we probably should talk about that for the viewers at home. Well, we had been saying there was a clear technical level here that if broken, there was a gap, right? So
yeah, and I think I tweeted last week that you were probably sat there feeling quite smug.
Yeah, you were helping. You were basically pushing me down my victory lap, basically, right? Which is quite funny. But it's not really a victory lap. It's not like I made loads of money off the sell-off. But that's not really what I'm trying to do with the options necessarily all the time. I'm trying to manage my risk and protect myself from these sort of technical breaks that happen. So, yeah, it was clear that vols were quite cheap, liquidity was thin, and it was like, do I want to sleep easy or not? And as we were breaking below 3,300 on ETH and around 60K on Bitcoin, I was like, yeah, I'd rather sleep easy here. So I invested a little bit of cash into some very short dated puts on ETH, and I did a few other protection trades on Bitcoin. But yeah, the ETH puts like made 9 times their money in like 1 or 2 days, and I was then able to monetize them. Because the thing that a lot of people do wrong when they put hedges on is that they breathe a sigh of relief that they're hedged. Oh, great, I put the hedge on. And then the market just bounces back and they don't do anything with it.
Yeah, and then you've just wasted premium.
So yeah, I mean, well, you've protected yourself from the drawdown, so you didn't have to liquidate. You didn't get liquidated on your exposures or whatever, but you didn't capitalize on any opportunity, basically, right? So for me, it's like, you can do a bit of both. And yeah, for me, down at 28.50, that was a huge level on ETH. And I was like, okay, we've already smashed through, already wiped out a load of longs that were probably speculating ahead of the ETF launch. I think this level is probably a bit more secure that it's going to hold. So that's why I started monetizing the protection.
So now,
as I said on X.
Yeah. So now, like we've had the flush, which again still feels to me very like Mt. Gox, German selling related, so very much a flow kind of dynamic. Because actually the flip side, and we can kind of get into it, but the flip side is the macro is just developing perfectly. I think we had a pretty soft like non-farm report, unemployment's ticking up, the Fed look like they're leading us into a September cut, so like the rate cuts are here. I described it this week in writing for London Crypto Club's Connecting the Dots. We're about to move out of this macro purgatory into macro heaven as the rate cuts come. Liquidity cycle's about to pick up. There's going to be a lot more treasury bill issuance, drawing down on that RRP. So liquidity is going to be improving. The rate cuts are coming. US yields looked like they topped out and rolled over last week. The dollar looked like it was rolling over. So everything was set up for
CPI to play ball this week.
Yeah, so that's going to be an important release. So it feels very much like there's just this sell pressure from this flow dynamic, and then that's sort of liquidated us. It feels like an opportunity. Interesting now, given that you were well positioned for it and you monetized some of those hedges. How do you position now, given where we're at?
I'm lighter again on hedges. I've still got my BTC hedges on. I'm still like a little bit suspect of this BTC move. So I wouldn't be surprised to see a bit more downside. But I think ETH is kind of like, it's going to get its inflows, right, this week, or you're going to get a feel for what the inflows might look like. So I kind of think ETH's got a potential pop in it this week after we see a few days of inflows and whether they're there or not, pushing it higher. Bitcoin, on the other hand, doesn't have that. We did see a pickup in ETF flows, obviously buying the dip, but I'm not quite that convinced that we've seen the bottom yet in BTC. So I don't feel comfortable being unhedged on BTC. So I'm pretty much hedged out most of my exposure on BTC via like risk reversals or whatever it is, which still gives me upside, but just kind of keeps me, safe.
Yeah.
But ETH, I'm a bit more long, and I'm a bit more aggressive on ETH right here.
Yeah, sure. And how about you guys? What are you seeing and thinking?
Well, sometimes the phrase Bitcoin halving feels like Bitcoin's going to halve.
Sometimes it's like a week.
I think you still have these flows. Mt. Gox, which I had to look up where that name came from. And do you know the background of it?
No.
So it's interesting. So it was an online card trading platform.
Card trading
platform. So there was a game called Magic the Gathering, MTG, online exchange. Because I thought it was some mountain in Japan.
Yeah.
But it started off as a card trading platform.
Okay.
And at the time they thought, we'll allow people to trade Bitcoin. right, to exchange Bitcoin on the platform.
Yeah.
And I think at the time, 70% of all Bitcoin was going through that platform.
Yeah.
And then it got hacked for something like 750,000 Bitcoin, which has then been locked in since 2014.
Yeah.
And I think the view is the people who've been locked into that litigation have done a great trade.
Oh, amazing.
Because at the time it was about $50 per Bitcoin.
Yeah, 100%.
And now they're getting it back at
but they didn't think they were getting it back.
They never thought.
False hodlers. I must admit, like, I think I've underestimated the impact of the unlock. And I think we spoke about this before, in that my kind of assumption was certainly the bigger like holders of that Bitcoin would have hedged in a lot of it. So net probably unwind the hedges, sell the spot, whatever, wouldn't have such an impact. And I'm still not convinced it is actually having an impact from the actual supply in terms of what's going
Germans
through.
Have been smashing it out.
They've been smashing it. I mean, God, they've been making a right mess of that.
Someone needs to give them a lesson on execution.
Yeah. But like, I wonder whether it's more of a narrative thing, and in the thin, like holiday thin markets and stuff, how much is actually being like hitting the market and being sold. I'm not sure, because I say, like, if you were sat on that and you've seen it go from wherever we were back in, when was it, 2014 to now, I can't believe
1000x.
I can't believe you're not hedging it and going, right, I'll lock that in like at these levels if you're expecting it back at some point.
But this is all finite short-term flow, right?
Yeah.
And that's going to wash through the market.
Yeah.
And then it goes back to the more longer-term flows.
Mm-hmm.
So if you look at ETFs now, ETFs own 7% of Bitcoin.
Yeah.
And US equity markets, I think they own 20% of the US equity markets now. And also, I guess the people who have been trading ETFs and be getting into ETFs just now, it's not widespread adoption yet. It's, if you look at the breakdown of who's been buying the ETF, it tends to be large hedge funds, bigger institutions.
And if the large hedge funds are buying, they're probably selling futures against it and doing the arb.
Futures.
Yeah.
Right. Why would they be waiting to buy the ETF, especially?
But in terms of your average punter who's putting 5% of their pension fund into crypto, I think that's yet to come. So there's this ETF steamroller, which I think over time will continue to go through the market. And Bitcoin is still a relatively small market. So it's a $1 trillion market. Gold is a $16 trillion market. So it's still relatively small. So those flows can make a big difference to the underlying price.
Yeah, which is why I think it's hard to not see ETH rally.
Yeah.
Because like, it doesn't need that much flow to get it going. Because the depth on the offer on ETH, like how big is it going to be really? Right. But we'll see. I mean, I could be wrong on that thesis. Right?
I guess maybe the difference as well is more people know about Bitcoin. Probably a large percentage of people who in traditional finance and traditional investors won't be that familiar with Ethereum. So an Ethereum investment might not be as attractive to them. Exactly.
Yeah.
They need to start watching this podcast. Okay, tell us a little bit more about, there's a bit of analysis. We've got some charts that we're going to share from you. One on vol and one on skew. Why don't you tell us a little bit about what you're seeing in those charts?
So I guess in terms of the vol one that we've shared with you, so I guess maybe we could talk a little bit about our data set. So we're obviously consuming every tick of every option that's going through the market. We then take snapshots of those every minute, and then we build what would be viewed as an OTC vol surface. So if you're an OTC vol trader, you think in terms of the at the money, the 25s, the 10 delta strangles and risk reversals. So we build that surface every minute, and then we sort of like rebuilt it historically since April 2019. So we have about 5 years of minutely Bitcoin and Ethereum surfaces. So about 5.4 million vol surfaces that we have that you can explore and you can look at the data from. So I think as we were talking earlier, when the FTX event happened, the front end vols spiked to over 100%, 100, 150%. I can't remember exactly where it is. Whereas if you then look at how vols have evolved since then, when there is big moves in vols, they tend to be less extreme and they tend to correct fairly quickly. I think that's what we see in the data. So that's in terms of the at-the-money vol. Obviously, the long-dated at-the-money vol is much less reactive. But then if you look at the vol surface itself, so the back-end skew is positive, and it's been positive for about think 18 months or so.
Mm-hmm.
So long-term macro, the surface is saying Bitcoin goes higher, whereas the short end of the skew is very dynamic and is very correlated with the underlying.
Yeah, something we've been talking about, right?
We see that in traditional markets as well. If you look at the dollar-yen market, for example, you'll see similar type of structural.
Front end's always more.
The front end is very dynamic and very correlated with the underlying. And that's very, very pronounced in the data. So if you were to look at the chart of the front end skew against spot, it's almost a linear relationship. And you see that in many similar type markets in traditional finance. And again, in traditional finance, we've built up a lot of infrastructure and tooling to integrate that sort of understanding into your risk management system. So if you were asking us, what's my portfolio going to look like if Bitcoin goes 10% higher? We could just shock Bitcoin 10% higher and say, this is the value of your portfolio. But if we understand the dynamics of how the market behaves,
the surface move,
a much more informed view for you about how your portfolio is going to react is to study that historical data, understand those relationships, and then build those within the risk management for you. And again, in rates and FX, because you have that close relationship between the surface and the underlying, you can in some sense hedge some of your surface moves with your delta.
Yeah,
right?
It's like a skew delta surface.
Yeah, it's called the backbone in rates, and it's has different names.
It's called the backbone.
The backbone in rates.
The backbone. That's funny.
And it is how the backbone of the curve moves with the underlying.
Yeah, that's interesting.
And that tends to be embedded in a lot of risk management systems within traditional finance.
Yeah, in equities they call it skew delta, or they've got various names, anchor delta sometimes. But what do you think is the reason then that short end skew is just so crazy volatile, like in crypto?
I guess, I mean, you could argue that it's more retail play in the short end. People are reacting, people are getting liquidated, people are panicking. But then you do see it in established markets as well. I mean, as the market's going down, people are going to buy downside protection. The market makers will mark the surface up. It's just that it's more correlated with the underlying because that's the flow that is going through the market in the front end.
I guess from my perspective as a trader who kind of experiences these moves down and uses options to hedge himself, my logic would be when the market's coming down, why did I buy a 3-day put option instead of like 1 month or a 3 month, right? Because the premium is just so much cheaper. And I know that the move could happen in 2 days because it's crypto, right? So because moves can happen that fast, like I'm not going to buy an S&P put that expires in 3 days if I'm worried about equities, right? I'm going to buy a 1 month minimum probably. Yeah. But in crypto, I don't need to because I know if the levels break, everyone's going to get wiped out and we could easily do 20% so quickly. So that's part of even though I'm not this crazy speculative, degen, I'm using it to, well, maybe I am a little bit. I'm using it to hedge myself and I'm recognizing the value in that hedge in the front end, right? So I guess maybe I've answered my own question, right? Yeah.
I have a comment as well. So everybody nervous, last 7 days move was quite dramatic, 18% or something like that. So how often do you think that it is, because I looked at the distribution, I looked at the data, went back and said, so 7 days and in the last year, where's the distribution? How does, in a week, Bitcoin move? Yeah, it's quite symmetric actually. Thanks to the ETF moves, we had actually up moves of 22% over 1 week when we had back in March. And everything's pretty much not that extreme. So I wasn't that concerned. Of course, I go back to 2022 and you saw 50% and it's much more sort of skewed on the downside, that sort of weekly move that you observe. Yeah.
So the empiricals is basically saying that there should be the skew shouldn't be very steep. It should be quite a neutral
It's quite neutral and the sort of, realize over the 7 days. So if you think a big window, but it's also, well, I don't know if you've seen the same or.
Yeah, so it makes me like I'm kind of numb to like these moves now. Like I've got so much conviction in like the secular trend and like the long term story.
Did you have any dry powder to buy it?
No, I didn't. Do you know what? I bought the last Bitcoin I bought. and I've got this like kind of like DCA thing going on at the moment, where like first week of every month I'm sort of buying some. Just with some cash flow I've got.
We're going to all front run you now.
Yeah, but like I
massive size coming in to buy.
I bought and just to be transparent about myself, I bought at 62k, and I don't think it's traded above there since. but I'm comfortable with it, right? Because you like this is
you can sell some options just to get a bit more.
Joe, and I
bring
did,
yourself down.
I did.
Dave's sworn against selling.
But like we spoke about last week, you know, the sense of caution around these flow dynamics, and we still like into these summer months, like there's still this kind of malaise and like lack of real appetite to, like, we need a spark, and maybe it's the Fed. We need a spark for people to come in, or if it's not the Fed, maybe the spark is actually just the flush and better levels. Because, like, to your point, if you look at like the long-term skew, sort of structurally, everyone's still positioned, or at least thinking that we go a lot higher in price. So it's kind of like you now we're probably at levels where, if you've been sidelined a bit, you know, like, it's probably time to start dipping in, which is why I think we possibly are in and around the lows right here. Again,
are you not surprised though that we've decorrelated so much from stocks? Because stocks just keep going one way, right? Yeah. And what's driving that? Like, why is it so decorrelated, given that the macro story is kind of intact? Stocks are kind of doing what they should do in a dovish rates type move. Crypto's getting nailed. Yeah, but like I've been thinking about this quite a bit, because actually, like, these stocks are kind of playing out perfectly to the macro view. But I guess they didn't rally like that hard. But they didn't rally that hard, and that's the thing. Like even people talk to me about gold, and like they almost speak as if gold's outperformed Bitcoin this year. You know, no, it's like you could argue that everything's playing catch up to Bitcoin, and Bitcoin had its move. Everyone front, and then it's just then it's just settled down. And then a drift for Bitcoin could be in a 20% range, right? Yeah, which is kind of what we're seeing. So basically, you front loaded the inflow. Basically, the ETF launch front loaded all the buyers. Yeah. So no one was really left to buy who was going to buy, right? So whilst now stocks and everything's catching up because the macro is positive, well, Bitcoin, everyone already bought Bitcoin, so they're not going to buy more because, you know, so I guess it makes, and then you've got the outflows coming from these distributions. I suppose that does kind of explain it. And then also, like, we talk about liquidity a lot, and I talk about within my framework, like, if you look at liquidity and measures of global liquidity, for the last quarter or so, that's just drifted sideways. That's gone nowhere. So, like, you had at the start of the year, liquidity kind of picked up, and then liquidity cycles just kind of flatlined. And this is why, again, going into throughout this quarter, as we start to see more bill issuance and stuff like that, you should start to see liquidity pop higher. We've also got, I talk about China a lot. We got the third plenum on the 15th of July, 15th to 18th, where basically Xi will outline his plans and stuff. I think there's probably been some caution in terms of, like, really kind of firing liquidity into the Chinese market, because he wants stability, and obviously the currency is under pressure. So you might actually see a lot more stimulus past that date. So I think, like, the Chinese side of liquidity will pick up quite significantly past that third plenum on the 18th of July. So I think we're going into a much better liquidity environment, which will pick up. And I think that will start to correlate with higher Bitcoin. And then I say, we've been in this, if you think we came into the year with 7 cuts price for the Fed, and then we've had this kind of resilience of data, which, again, I keep arguing is a function of the fact that they are running insane level deficits. So in a weird way, it supports the longer term story for Bitcoin. But so each month we've had kind of mixed data and fairly strong, resilient data out of the US. So we keep pushing these cuts out. And that's why I keep talking about this kind of macro purgatory, because no one's been able to fully embrace the rate cutting cycle from the Fed. We've obviously seen others like the ECB cut rates, but I think that will be quite a kind of mind shift, I guess, as soon as the Fed cut. And I think they're going to, there was a piece in the Wall Street Journal this weekend, and Nick Timiaros, basically kind of leading that we're going to start seeing September cuts. So the Fed will have to start leading everyone into that. And I just think that will start to kind of start to get people put these macro trades on again. And I think Bitcoin will start to benefit from that. But it's just about, where do you catch this falling knife
of this flow that, you know, how much of Mount Gox is going to hit the street.
Yeah, hence why I've still got the hedge on Bitcoin.
Yeah. So I'm kind of like looking at it, and someone kind of hammered me on Twitter or X the other day about, oh, you always just ball post. And I'm like, well, it's like, because structurally the story hasn't changed. In fact, we're leading into the macros actually unfolding really, really nicely.
I hope you took a screenshot of that. So later on in the year, you can kind of show it.
Yeah. Careful with Sheldon fraud and all that sort of stuff. But like, and also we're up what, 35% even with this sell-off. So it's kind of playing out well, and we're just sport in crypto, right? That things move so quickly. But
so Katia, William, tell people where they can learn more about immersive finance and what you guys do.
You can reach us in our website. We have a Telegram channel that you can follow to
throw a bit of analysis on there for people. Yeah,
a little bit of analysis we throw, especially event-driven type of things.
Okay, that's good.
People can always sort of reach us out for demos of the platform, and we hope.
Yeah, the backtester sounds interesting. I'm always happy to check out a backtester.
Imran sniffing like a free trial here.
Yeah, totally.
A lot of traders can be quite disappointed that their great strategy
doesn't work.
You run it historically, and it has massive drawdowns.
It's the holy grail, and it's like the backtester's wrong.
But then it helps you tune your strategy.
Yeah.
So,
It's actually like the flip to like the memes out there around like the back test, like all looks great. The reality is like,
no, it's usually quite the opposite.
Yeah.
I have this great idea. I've been trading this for years. But a few slip ups, and then you run it, and it's just
But that's what we wanted to provide. Really, is the ability for traders to kind of do things much more systematic. And so, for example, the risk reports that we run, they can be run like every second. The traders can call that every second and run a bot on the back of it to delta hedge. So it's really kind of taking more to the data-driven approach to what can be done in this space.
And do you provide the bot as well?
No, we don't provide the bot. We can provide the bot, but it's at your own risk. So we can have a conversation about it.
If they're interested in us helping them build it,
right?
Looking at execution, about how they should manage their delta.
Cool.
We can work with people like that.
All right. Well, it's been a pleasure having you. Thank you so much for coming.
Thanks for inviting
Thank you.
Yes,
and
great.
That's it for today's episode, guys. So remember, like, subscribe so you can get these sort of guests on the show more often. We'll catch you all next week. Cheers.